You will never be consistently profitable until you fill that performance discrepancy gap. What exactly does this gap mean? This is the difference between your actual strategy in a month and how your strategy would have actually played out in that same month if it was executed correctly. The people who are consistently profitable have this at nearly zero. What defines them from the non-profitable traders is that 90% of traders have not fulfilled that gap. And what ends up happening is it puts you in this death loop where you're constantly taking losses, you have doubt and hesitation on every trade that you want to execute, you find yourself skipping trades, you're upset at yourself because you missed a winning trade that you were too afraid to execute, you end up revenge trading, and all of that ends up looping back to itself, to again taking losses, doubt and hesitation. And the solution to this, and if you've been watching my MMFunded channel for some time, you would know more or less what we talk about here, is rule-based trading, a trading system that decides which trades to take regardless of the current market conditions. What I'm saying is your trading system needs to have a disciplined set of rules. If those rules play out on the market, you either execute or you don't. There's no discrepancy in that performance gap. Essentially, an event will play out, which will be you formulating your trade plan. There will be a certain criteria that price needs to print in order for you to execute that trade plan. It's simple. If it doesn't print, you do nothing. If it prints, you follow through your entry criteria. If your lower time frame entry criteria prints, you execute. If it doesn't print, you do nothing. And this keeps things so disciplined and rule-based that it is bound and guaranteed to eliminate the discrepancy gap, redefining you into a profitable trader and that top 1% that is able to fill that gap. How can you make your strategy mechanical? And that's exactly what I'm going to show you in today's video so that you can solve this problem once and for all. And I'm going to walk you through the entire roadmap and breakdown on how I mark up the charts with my members, formulating that mechanical trade plan every single morning so that you can eliminate that death loop and have that clear clarity going into price every morning on what you need to execute on and what you need to stay out on. So if your set of rules plays out, you execute. If it doesn't, you walk away. Capital protected. I'm going to walk you through my exact trade plan, and this is exactly what I've used to help hundreds of members achieve funding and consistent payouts in the MMFunded community. In order to get started trading mechanically with the set of rules, there are four main key areas that you need to fix first. First up on this list is idea generation. So essentially what this is everything that you do up until the point where you're ready to execute your trade. Then your actual entry model, if that prints, you execute. If it doesn't print, you stay out of price. Number 3, trade management. Once you're in the trade and how you manage that trade in terms of taking partials, setting break even and taking the risk off the trade. And of course, any other decisions that you need to make around on the risk of that trade. My trade idea generation is essentially broken down into 2 separate parts. Number 1 is the directional bias. What is the higher time frame intention of price? Where is the expectation of both higher time frame and the entire bias all the way down to lower time frame, the expectation of order flow that needs to go. And then essentially, once I understand that directional bias, the selection of POI that I'm looking to trade off of. POI stands for point of interest, whether that be a supply zone or a demand zone. How exactly do we get started in identifying our directional bias? Well, firstly, you need to go and identify the current trend or the current direction of order flow, determining if price is, or the expectation of price is to target the weak highs or the weak lows, if we're bullish order flow or if we bearish order flow. And then secondly, you need to identify what's been mitigated and what's the current objective of price in terms of, is price coming from a supply, is coming price from demand, has price just broken structure, are we due for the swing pullback, are we now shifting bullish or bearish after the pullback, continuing pro trend. And that's all concepts we will go throughout in this video to identify your directional bias. And then also identifying available liquidity, clear double bottoms, double tops, trend line liquidity. There's plenty of different liquidity concepts that I also teach on my channel. And using these concepts to start finding our POIs that we can select to start to formulate and execute our trade plans from in alignment with the directional bias that we've identified with our mechanical set of rules. I'm going to show you how to do all of that just in a bit. Now, in order to identify your POI selection after you have that directional bias, there's multiple different rules or criteria that we can use to mechanically mark out that POI. Are you only going to look at the zones that led to a break of structure? Are you going to look at zones that created a flip or a supply to demand takeover, or vice versa, demand over supply takeover? Are you going to look for a sweep zone, a supply demand zone that was created after a liquidity sweep, and inducement zone, which is a clear supply or demand zone holding resting inducement or liquidity to draw into that higher time frame POI? Or are you looking for lower time frame POIs stacked within a higher time frame POI? Are you looking for demand zones in the discount of the range to buy at the cheapest prices possible? Or are you looking at supply zones in premium areas of the ranges to sell price? Are you looking for clean, fresh, unmitigated supply demand that hasn't been tapped into yet? Or are you looking to follow through the continuation of an existing supply or demand zone chain? You could incorporate multiple of these criteria to identify your POI. So for example, if we have a POI that led to a break of structure, but that is also holding an inducement available ready to sweep into that zone and is currently stacked within a higher time frame zone. More of these criteria together within a supply or demand zone, the higher confluence for that POI and the higher probability that price will pull back into that specific POI, react off of and continue in either pro trend or counter trend for the pullback phase or for the pro trend phase. My top 4 mechanical rules that I use is that the supply or demand zone needs to have create a break of structure. It needs to have available liquidity, what we call inducement, ready to sweep into that zone. It needs to be unmitigated and has need to have created an inefficient or imbalanced push after that supply or demand zone was created. And ideally, when those 4 criteria are lined up with your higher time frame directional bias, that ends up becoming a very high probable mechanical trade plan based on our rules. Now that you have your higher time frame directional bias and you have your POI selected looking to execute your trade plan from based on that higher time frame directional bias and also the mechanical criteria required for a POI, you can now set your alerts at that POI looking to execute your trade plan. And one of 2 things are going to happen. Your entry model is either going to print, you execute. Your entry model is not going to print, you stay out of price. But the same thing applies. We're going to keep our entry models as mechanical and rule-based as possible. First and foremost, in order for your lower time frame mechanical entry model to play out, you need to have your higher time frame point of interest mitigation, as lower time frame changes of characters or confirms happens everywhere in price. And that is why it's super important that that is only valid inside of higher time frame POIs in alignment with your directional bias. Point number 1, POI mitigation. Now there's many different criteria that can be valid for a mechanical entry model. Similarly to the POI, there can be multiple criteria playing out at the same time, all adding as a confluence. But importantly, what I look for in my entry confirmation is a strong liquidation of liquidity, which we call the manipulation phase of accumulation, manipulation, and distribution, which we will cover a bit more thoroughly as we hop onto the charts now. And secondly, after that strong liquidation, did price create a smaller time frame or lower time frame change of character or break of structure to the upside? After that break of structure, was there a supply to demand takeover inside of a higher time frame POI as confirmation? And does that entry zone need to sweep liquidity, or does it hold inducement to draw into that lower time frame change of character zone as your entry confirmation? Is there a momentum shift in order flow with a strong V shape after a strong liquidation? Are you going to incorporate fair value gaps into your entry model? One of my favorite entry models is an inversion fair value gap after a liquidity sweep inside of that higher time frame POI with a strong liquidation and strong order flow shift to the opposite side as confirmation in that higher time frame POI. There's many different ways and criteria that you can set for your entry model, and I teach all of these specifically and break them down inside of the MMFunded community. And there's also tons of videos on my YouTube channel and also in the free mentorship here on YouTube as reference. But essentially what I'm getting down to is your entire directional bias from top-down analysis from the higher time frame to the lower time frame intentions to POI selection to mechanical entry model needs to all be based on a disciplined set of rules. And this was a problem I had for many years in my trading journey. I used to be very loose with it. I often had many different criteria for every different entry, but I've eventually come to the point where I've mechanically figured this out for myself to get into the best trades possible based on the higher time frame bias and my POI selection and my mechanical entry model, hence why I'm sharing this with you guys today. And once you've had your mechanical entry model play out, how exactly are you going to enter that? Are you going to set your limits on the edge of the zone, the 25%, the equilibrium at the 50%, or cover the entire candle body? And this too, we need to keep as mechanical as possible. And then even dives further, deeper into this. Once you've entered and set your limits, how are you mechanically going to manage your risk? Are you going to set your stop loss behind the zone or behind the entire low after the reaction of that higher time frame POI? These are all things you need to consider in your entry model. Personally, I like to go for those tight risk to reward trades. So I like to set my stop loss behind the change of character lower time frame zone in that higher time frame POI, and also buffering that stop loss slightly just to cater for any spread or any commissions. And this is just the start, because the error where 90% of traders make is when it actually comes to entering that trade, how you manage your trades, where people exit trades, your emotions come into play, doubt, hesitation comes into play, pulling yourself out of early, long runners, etc., etc. But you need to start managing your trades like a robot. You need to become a muscle memory robot when it comes to trade management. And this is a major key in your trading plan that you need to keep as mechanical as possible. And if you don't know where to start, I always recommend to every trader, start with a fixed RR method. Fix your TP based on a fixed risk to reward. For example, I will always trade a 1 to 5 fixed risk to reward. So either price is going to run the full 5R, or we're going to run -1 at stop loss with no active management, or trail stop loss to break even after a certain risk to reward running in profit. However, you can adjust those rules to yourself. If you want to have that mechanical rule of when price hits 2R profit, you then drag your stop loss to break even. So then either that trade's going to be a full runner, but the important thing to take note of is as long as it's the same mechanical rules in every single trade that you take, and as long as you're not finding yourself changing these rules every single trade. The second method is to have a fixed TP based on a key level, whether that's a further up supply or demand zone, a structural weak high or weak low, or a liquidity target that you're looking to target. This scenario also keeps things as rule-based and mechanical as possible. However, your risk to reward is obviously going to be different every single trade, because when you're focusing your TP based on different key levels, every different trade plan is going to have or going to be a different situation. Therefore, some trades, as some S&D zones or structural weak highs will be higher than others, therefore your trades will be longer than others, but the important thing is to at least keep this as mechanical as possible. Thirdly, another way to approach mechanical trade management is to trail your stop behind your structural highs and lows. So for example, exiting on the first trade, and essentially what you're doing here is you having a open TP, so you have your stop loss fixed. As soon as you create that first break of structure to the upside, you set break even. Price pulls back, continues to create the second break of structure to the upside. You then drag your stop loss below that new strong low that has formed. And as soon as price pulls back and breaks structure to the downside, you've then exited your trade because of the trend shift. My personal preference, and where I found the most success in my mechanical trade management, is I actually use two criteria. I will use a fixed TP based on RR if I'm trading counter trend. For example, if I'm trading lower time frame or higher time frame pullbacks. If I'm trading pro trend in alignment with the higher time frame directional bias, then I will focus my TP on a specific key level, predominantly most of the time a structural weak high or weak low, or a specific liquidity target. But even within your mechanical rule-based trade management criteria, there's different questions that you need to ask yourself to still keep this as mechanical as possible. For example, how many pips in front of that key level will you set the TP? Are you going to keep it at TP at that weak high or at a fixed 5R? Or are you going to rather adjust your TP to the higher time frame key level at the swing weak highs or the swing weak lows or the swing S&D zone and hold your trade for a longer period of time? How many pips behind the swing low or the swing high will you trail your stop loss? These are all questions you need to ask yourself and that you need to make sure is mechanical as possible. Again, these things cannot be changing on every different trade plan that you execute. What time frames are targets based on? If you're executing on a 1 minute change of character inside of a M15 higher time frame POI, but you're looking to target the daily swing weak lows because your directional bias is now in alignment. So you need to ask yourself and keep this as well mechanical as possible. If you're going to use the 1 minute execution time frame inside of a 15-minute POI, you need to make sure those criteria remain the same every single time and is rule-based and disciplined every single time. And even once you're in the trade, running in profits, how much are you going to partial? Are you going to partial 20%, 50%, 70%? Those things as well, we need to keep as mechanical as possible. And then lastly, mechanical risk management. Not everybody's sexiest topic, but this is a super important part of trading that you need to mechanically master, because this for me is one of the most important parts of trading that you need to get right. I'm going to explain to you some mechanical risk management criteria that you can use within your trades, and also my top 2 that I use personally. And you need to make sure that you're super consistent with this, that you apply these rules in every single trade that you're in and every single trade plan thereafter. It's important that this does not change every time as well, because then there's going to be that discrepancy and that gap between your performance and your actual strategy. And these are some really good example questions that you need to ask yourself. Position sizing. Am I always going to risk a fixed percentage of the total account balance? Am I going to start scaling into the trade? Am I going to scale in when a initial position risk to reward is removed? Am I going to risk the entire account by risking the max daily loss? For example, the max risk percentage of the total of account balance. Personally, what I use is, if I'm trading a fixed RR method, counter trend, I will use a 1 to 3 risk to reward, trading 0.5% of the account. If I'm running pro trend trades, which usually can be up to a 1 to 100 risk to reward, I will risk anywhere between 0.1 and 0.2% of the total account balance. How to make your strategy as mechanical as possible? Well, we've now discussed idea generation, hopping onto the charts that morning and knowing your exact direction and bias, going into price action for the day, and identifying our mechanical POIs based on that higher time frame bias formation. Our mechanical entry models, once price pulls back or enters our POI, we need to make sure that we enter the same way every single time. And once we've executed and entered that trade, we need to manage our trades like a robot, like an algorithm. Manage your trades the same way every single time. Our risk management, our position sizing, I always recommend use fixed position sizing and risk a certain percentage of your account on every single trade, and risk the same percentage every single trade if you're trading a fixed RR. And once you can fix all of these elements of your trading, this will allow you to accurately measure and optimize your strategy performance, eliminating that gap and that discrepancy gap between your own performance and between the performance of your strategy. So let's now hop onto the charts to show you what this mechanical plan looks like and walk you through this to help you make everything as rule-based, mechanical, and disciplined as possible. The way you can think about this is when you try to explain your strategy to someone else, how can you explain it to them as simple and most understandable as possible in one sentence? If I ask that to myself, this is exactly what I would say to you. So essentially what I do is I trade medium time frame order flow in medium time frame POIs. For example, over here, we were creating strong highs, weak lows with a bearish order flow trend with lower confirmation execution inside of these medium time frame POIs. And simply follow through the order flow. Bearish trend, breaks of structure to the downside, price is creating strong highs, new weak lows, expectation of order flow is to always target the weak lows. Supply and control, so what we're looking to do is to trade pro trend with this. Pullback occurs, mitigation into the medium time frame POI. We're looking for lower time frame execution to continue targeting those weak lows. New break of structure, weak lows targeted, pullback phase occurred, lower time frame execution and confirmation to end this pullback phase to continue targeting those weak lows. Mitigation of a higher time frame POI, after new break of structure, pullback phase occurs, price respects supply, end of pullback, but instead of targeting these weak lows, we then break structure to the upside. Price took out the most recent strong high, and price is now creating strong lows. New break of structure to the upside, mitigation of old supply, where we can anticipate price with our lower time frame execution for a pullback phase. Demand now in control, mitigation of demand, lower time frame execution on the 1 minute, also smaller breaks of structure, supply and control, breaks of structures to the upside, demand now in control on the lower time frame to continue targeting our relative weak highs. Pullback phase occurs, mitigation of older supply where we can anticipate that, new mitigation of a demand chain, rinse and repeat. Lower time frame execution to continue targeting those weak highs. So essentially all you're doing is you're following through the order flow until we target the next weak break of structure. That order flow then changes. We then want to focus on getting long on the new strong lows that have been created, the new demand chain that has been created to now target our newly created weak highs, and dropping down to our lower time frame to look for our mechanical lower time frame execution model. This is not a specific entry model I use, it's just an example of a basic change of character. Essentially why I'm using this example is to show you the fractal nature of the markets. What applies on the 15 minute, the same order flow rules applies on the 1 minute. What applies on the 1 second, the same order flow rules applies on the weekly. There will be weekly changes of characters, weekly order flow shifts to the upside and downside as exactly what occurs on the 1 second chart. And that is what we call the fractal nature of price. Because price does not follow time, it follows where the order flow and money lies in the market. So this is kind of my overall plan in a very simple form. Now what happens is traders have the most beautiful entry models formed in every single higher time frame POI, and they understand that they're trading in line with the medium time frame order flow. It looks like a beautiful trade plan every time, and they're waiting for the pullback into their higher time frame POI, looking to execute their lower time frame confirmation. And they're hitting and executing on every single medium time frame POI. And they start wondering why they're not getting a good win rate or a good strike rate. And they're not getting as high as a strike rate as what they could be getting. And what you need to understand is one, yes, POI selection, but a much bigger part of this, building the narrative of price as a whole. And this is where we now need to introduce a third time frame. And that's why we have a 3 time frame philosophy: a higher time frame objective and narrative and bias, medium time frame POIs, and our lower time frame execution in those medium time frame POIs. On the left hand side, I've labeled the swing structure as our higher time frame, the internal structure as our medium time frame. On the right hand side, I've labeled our lower time frame execution in a magnifying glass effect over here, just to break this down more visually and easily for you. Now, all of my lower time frame entry models are not going to be on the specific example that I've got here, because the drawing will become very complex. There's a lot of different lower time frame entry models. So we're really just going to be focusing on the higher time frame objective in alignment with the medium time frame POIs, and then also a more basic lower time frame execution. Because there's also no point in learning the lower time frame executions when you have not mastered the higher time frame objective and the medium time frame order flow. In this lesson, we're going to start off by looking at the higher time frame objective and narrative, what our higher time frame structural story is. Within that higher time frame structural story and bias, our medium time frame order flow that is happening within, so that we can identify what POIs we can trade off of, the high probability POIs, the low probability POIs, and then within those medium time frame POIs, our lower time frame execution, all in alignment together. Whether we want to trade the higher time frame pullback and the current medium time frame is pro-trend, catering for the higher time frame pullback, and we want to start looking to get short, we can look to follow through the supply chain, looking for our lower time frame execution, but understanding that it's not going to be very smart riding this pullback for very long and targeting areas of pricing way lower down, because in reality, our higher time frame story is these are strong protected lows. The expectation is to respect these strong protected lows and eventually to target those higher time frame objective week highs. So therefore, we automatically know once the medium time frame starts realigning itself with the higher time frame objective, this is going to be very good probability for a potential swing longer term runner trade to target our higher time frame week highs. If I'm swing trading, I will use the daily time frame as my swing time frame. So we'll just make a note over here as well. Swing daily of H4 will then be our medium time frame POIs. M15 will then be for our lower time frame execution. If I'm day trading, which is what I predominantly am, our higher time frame narrative then shifts down to the H4. Our M15 becomes our medium time frame order flow, and our lower time frame executions happens on the M1 or the M5 timeframe. Sometimes as a day trader, I will also take the daily into narrative just to get that extra understanding of what the higher time frame 4 hour is doing. But we don't need to get that technical in today's video. We will cover that in later videos on my channel. I've already covered that in some videos in my channel. All of this is covered fully in depth inside of the MMFunded mentorship, where you will get access to all of the lower time frame entry models, and specifically my live streams going onto the charts every single morning, marking this up. So let's slow this down and start from scratch, and much more slowly for you guys to follow with and understand. So we're going to start off with our higher time frame objective. And there's 2 questions that you need to ask yourself when trading or when identifying your higher time frame objective. Am I trading higher time frame pro trend, or am I trading higher time frame counter trend? So for example, am I trading pro trend longs in alignment with the higher time frame story to target those weak highs, or am I trading counter trend pullbacks of the higher time frame swing structure after the previous break of structure, where we can anticipate of all the areas of supply. Understanding in this point in the market, yes, we are trading counter trend, so it's not going to be realistic holding these trades for very long. I always like to suggest trade the internal structure, target your internal weak lows when trading swing counter trend or higher time frame counter trend. In this scenario, this is where I like to trade a mechanical fixed R of usually 1 to 3 risk to reward, targeting those relative internal weak lows. And secondly, you need to ask yourself, if I'm not going to trade counter trend and not trade these pullbacks, if I'm not confident in that yet, then we'll let this play out and wait for the internal time frame, our medium time frame, to start realigning bullish, take out those strong highs, create new strong lows with demand in control. And that will then answer your question, am I now trading pro trend? Do I want to wait to trade pro trend for that break of structure to the upside after the higher time frame POI mitigation? Then we can follow through our medium time frame order flow, demand and control, mitigation of those medium time frame POIs, lower time frame execution inside of those medium time frame POIs in alignment with internal pro trend and overall swing pro trend. Then we can start to look for those tight risk to reward trades within our lower time frame 1 minute execution to target our swing structural weak highs. And this comes back to my arguments earlier. What so many people do is they trade the medium time frame POIs, they trade every single execution model that plays out, but their strike rate isn't very good. And the reason why is because they don't have that higher time frame narrative and they don't know when price is going to change trend. If the anticipation of price is to now go bullish when they're still shorting off supply, or if they're looking to long price off newly fresh premium areas of demand that will just cater for internal pullbacks and they get stopped out, it's because essentially they don't have this higher time frame narrative of price. And because so many traders are just immediately following the medium time frame order flow, they can't anticipate if they're trading pro trend or counter trend, and essentially they just have no idea on what side of price they're on in terms of the higher time frame objective and the higher time frame narrative. Because simply your medium time frame that's happening within your swing structure is just not enough to get that clear picture of price and knowing which trend or side of the market that you're trading on. So many times traders are shorting price in the higher time frame pullback phase when they don't even realize it, and they're just trading on the complete opposite wrong side of price, when truly the current trend of price is still to go long and remain bullish on price. All your medium time frame does is fulfill the objective of the higher time frame. The medium time frame is not something to solely rely on as your story and your trade plan going into session of that specific trading day. So to break this down, the thick black line is our higher time frame objective. We've most recently had a swing higher time frame break of structure to the upside, created a new strong protected low. After that pullback phase starts, when the internal break happens to the downside, which again we can anticipate of all the areas of supply on previous higher time frame legs, we then create a new higher time frame structural weak high. So we know in the future that the eventual anticipation and objective of the higher time frame is to target this weak high. Now this slightly thinner gray line is our medium time frame order flow that is happening within our higher time frame story. Again, this medium time frame order flow just fulfilling the objective of the higher time frame. What do I mean by fulfilling? Well, after every break of structure, we can identify the start of a pullback phase. How do we identify the start of that pullback phase? We use our medium time frame order flow within the higher time frame objective to identify the start of that. We have a new medium time frame break to the upside, strong protected low. Medium time frame pullback starts. Instead of targeting those weak highs, we broke structure to the downside. New medium time frame strong high, although this still remains as our higher time frame swing weak high, we can anticipate a medium time frame pullback, mitigation of supply, lower time frame execution to continue targeting those medium time frame weak lows. We then know that all of this bearish price action is just catering for the due higher time frame swing pullback phase. And how can we identify the end of the pullback phase? Well, firstly, what I do is I mark out the 50% of the higher time frame swing range. This is what we call equilibrium, discount, and premium. Price is always higher probability to start shifting medium time frame bullish after discount mitigation, because institutions and banks that is pumping millions and billions of dollars through price want to buy price at the discounted cheapest prices possible. After discount mitigation and the extreme higher time frame demand mitigation at the swing strong protected low, we can start to anticipate the medium time frame order flow to start aligning bullish. Previous internal break to the downside, strong high, pullback started, mitigation of the higher time frame swings demand, and new strong high broken to the upside. So now, instead of creating strong highs on the medium time frame, creating strong lows. Pullback phase, mitigation of the medium time frame demand, lower time frame execution. We're now bullish in realignment with the higher time frame POI. New medium time frame break, medium time frame pullback with a lower time frame change of character as confirmation, mitigation of the medium time frame extreme POI, lower time frame execution as confirmation to continue targeting those weak highs. So now we know we are pro trend and we have that clear story of the higher time frame objective. Very good probability that price will target our higher time frame weak highs after the medium time frame has now realigned itself bullish with the higher time frame bullish objective after mitigation into extreme demand, or at least discount of this higher time frame swing range. So many traders are not understanding this higher time frame objective. They're trading so much on the medium time frame without the picture of the higher time frame, hence why it's severely affecting their win rate and their consistent profits and their consistent percentage gains on their accounts. Because all the higher time frame does is it teaches you to know when to get in aggressive, when to get in conservatively. For example, if you're looking to get in aggressively at the H4 or the higher time frame strong low with a simple lower time frame change of character, but the medium time frame hasn't aligned bullish yet, or if you rather want to leave it and play it conservatively, let that internal break happen to the upside as confirmation, that pullback phase to then start executing to target our higher time frame weak highs. Or if you want to go more aggressive after the swing break of structure, mitigation of all the supply, and looking to trade shorts counter trend, we can wait for that medium time frame break to the downside, the medium time frame pullback, lower time frame confirmation in that supply. We can then start to execute counter trend shorts, but we know we're not going to target areas such as the higher time frame strong lows or deeper down areas. In the interim, we can just target our internal weak lows at a fixed mechanic R, just riding that pullback phase and scalping this pullback phase. Now, this is just swing structure. If you've seen some of my other videos, you would know there are three structure types. We have swing, internal, and fractal structure. And when you start to bring all three of those together into the mix, and that's where people get really confused and really thrown around in the live market and get themselves into all sorts of a jamble in their trade plan. For example, what people will do is they will know we've just had a higher time frame break of structure, medium time frame of alter supply, looking for their lower time frame execution to go short. Are you going to go more aggressive and target these shorts without the medium time frame internal confirmation, or are you rather going to let price play out, print the medium time frame confirmation, pullback phase into supply to then start looking for your lower time frame confirmation? As this setup for shorts here will be much higher probability than this setup for short here without the medium time frame confirmation. This video on the screen over here is going to teach you far more in depth how I approach London session and New York session every single day with my three structure types, identifying my higher time frame objective, identifying my medium time frame order flow, confirming that higher time frame objective, and also my executions with the lower time frame execution. This video will go over in depth some of the live trades that I've taken this year and the past couple of weeks on Euro USD and XAU USD, following through far more live examples of what I've taught you in today's video. So this video is a very important follow through of the tutorial and the lesson that you've just watched here now today. So what I recommend you do is to follow through with this, is save this video to your watch later if you can't watch this now. If you can watch it now, eliminate all distractions, take notes and study this well. And I'll see you on the inside of this video.